us as producers and the customer that I work with, they end up wearing many, many hats. So they're the CEO, the COO, the CFO, HR department in some instances, but they have to wear all of those hats. And then they also have to buy cattle.
As a banker, what I really want to see is everybody keep their hedges in place, especially in a market like this. If we were at the bottom end of the market, I probably wouldn't be as big an advocate for you probably should keep your hedges in place. And that's always a borrower's decision. It's really not the bank's decision. It's the borrower's decision. The key is you got to have a lot of communication, whether you be the largest borrowers out there feeding cattle or the smallest. And your banker really needs to understand what you're up against when you are in a market like this where prices have risen, significantly. Everybody's in a little bit of a cash crunch. It's not easy to get that money on a day's notice. You need that money in your commodity account or you're going to blow people out of hedging. That's just the way it works. But what's important from a producer standpoint is we all have to be having the right communication, the right conversations so that money is readily available.
Welcome to We Live It, the Live Ag Podcast, your source for livestock market insights, management strategies, and real conversations with those who don't just work in the cattle industry, they live it. Here are your hosts, deCordova and Casey Mabry.
Welcome back, they said, to We Live It podcast. deCordova, Casey Mabry, hosting these things here, trying to bring you educational value to the industry. Casey and I had this idea, several years ago, and just kind of now getting to where it can come to tuition. Trying to have guests on here to join us that can educate us in different parts of the industry. So we want to welcome y'all back. We thank y'all for joining us. We want to ask you on whatever platform you're watching it on, if you'll hit the subscribe button and the like button. So subscribe and like. Is that what she said, Casey?
You're good at this.
The thumbs up. But be sure to subscribe it for us. But without further ado, I want to welcome John Sloan with AgTexas out of Amarillo, Texas. We're going to kind of get in some insights on the market volatility and then what that looks like. And then we might go further on into some strategies and some details. Want to analyze the market a little bit and what that looks like. And then maybe move on into talking about, okay, how do we make those plans and what those plans look like going forward as you try to grow and you try to get bigger. That's the name of the game is, let's start out small and then let's gradually get bigger. And what do we have to do that? So, Casey, if you want to kind of lean in on that a little bit, and then we'll get to John and we'll ask him a few questions and maybe roll on with some stuff.
Yeah, a lot of the ideas that you'll have from this show is things that we experience or we live through,
Yeah.
So whether that's, I know, how about that?
No,
let's have that in. So one of the things that we've run into here recently, as we've seen the market escalate and as we've seen some different things occur, is a lot of the things that my customers are talking to me about is the banking side of things. And so I know that's one of the deals, and I've said that at length, and whether it's been on here or talking directly to my customers or my clients, those are things that we don't necessarily think about every day as those banking relationships, or they're not necessarily as fun to do as going out and buying a set of cattle or feeding cattle or doing whatever. And John, I told you this before we came on here, us as producers and the customer that I work with, they end up wearing many, many hats. So they're the CEO, the COO, the CFO, HR department in some instances, but they have to wear all of those hats. And then they also have to buy cattle, and they have to, run their feed yards, and they're doing everything from the windshield or through the windshield of their pickup. And so whenever we get to points like this, it's like going to the doctor almost. You got to get more consistent with that as you progress or as you age or you morph into things. So I think it's important that we go through this. I think it's going to be something that's super educational, hopefully, that we get to get experience with that. So,
John, if you want to kind of introduce yourself and tell us a little bit about you, where you come from, where you started, where are you from? I mean, where did you grow up?
Yeah, thank you very much, guys, for having me here today. I really appreciate it. I do work for AgTexas in Amarillo. I've been with the Farm Credit System for almost 30 years now. It's hard to believe. But I did grow up in a small community called Truth or Consequences, New Mexico, which is just north of Las Cruces, New Mexico.
Truth or Consequences, New Mexico.
That's the most unique town in America.
Are you sure that's okay?
That's perfect for the cattle industry.
Yeah, it is
truth or you got consequences.
You got that right.
But yeah, I did grow up in New Mexico and worked as far as my banking career goes, I've worked in New Mexico, Arizona, and Texas for about the last 14 years.
Cool. That's kind of awkward silence right there, wasn't it? So, well, let's just kind of get right into it and get into the meat of it, of kind of what we wanted to start discussing. And the first thing we want to talk about is this market volatility, okay? So what does that look like on your side when this thing starts doing what it's doing? I mean, we're getting these big highs, and then, these things are costing so much more. Our finance levels are going up, our interest rates are going up, the margin calls are going up, and then it's just such a risk now. So kind of on your side of that deal, kind of explain what that looks like on your side and what you guys look for to balance that out and to help.
Sure. Well, so the way I look at the market is if you think about the volatility and what's happened over the last, say, year or so, the cost of these animals has risen by how much? Probably 40, 50% higher in some cases, correct?
Yes, sir.
So we've easily doubled what it costs to buy these cattle.
Right.
For sure. I mean, beforehand, a lot of the cost of production was, financed maybe through feed yards or something like that because grain costs were higher. But as the grain costs have come down and cattle prices have gone up, the bulk of what we're having to do is spend it on cattle. So we've easily doubled the price of cattle. Right.
So, if you think of it in those terms, if you had a $1,000 animal, say a year ago or 18 months ago or whatever, now those animals are 2,000 plus, correct?
Mm-hmm.
So you just have a significantly amount more money tied up. And anytime you're in a banking relationship with any bank, you're going to have to put some of your own equity into the deal. You're not going to likely ever get 100% financing on a house, livestock, or anything. So more and more of the producer's money is tied up in their operating line now. Even though they're making very good money, most likely, all of their cash is now tied up because they're paying so much more for the animals, the feed, interest costs, et cetera. And it's more and more important to have a great banking relationship and a banker that really understands how to get you through times like this, because it's gotten to be much more complicated. And quite honestly, there are some banks out there that may not have the experience in terms of market type cattle to really structure the loans correctly. So that to me is the most important part, is having the right relationship and having a banking institution, a lender that really understands the industry and can help you through times like this where the market's really high, or let's say it happened to drop 50% in 3 months. You'd have the flip side, and then you'd have the opposite problem where you may very well be losing money on every pen of cattle.
Yeah.
So that's the way I look at it.
So I was looking at this over the last couple of weeks, and so if we look back at the market, and I'm going to talk fed cattle market 2021 market was $1.35. If we look before that, the market had really never. I mean, it had gone up into the 172 area back in 15, 16, obviously, but then we had broke back in there, and we spent 5 years consistently in a channel between $1 and $1.40. So we had a $40 range in cattle, and then we went on this ensuing rally over the last 4 years where the market went up into the 160s, 170s, 180s, and then I have not run into and John, this is what I want to really kind of get into and dig deep into. January 28th of this year, 2025, I probably heard more people running into borrowing constraints more than I ever have. And since I've been doing this or exposed to this. And I think a lot of those situations, I think there's like multiple different parts of it. I'm going to tell you the industry is probably more hedged now, and so they're having to make margin calls, obviously. But then also they're having to like buy cattle. There's also an instance where they're prepaying feed right there at going into the end of the year. And I think a lot of guys, the stoutest guys that I've dealt with from an equity standpoint, running into crunches from a borrowing capacity standpoint. And so that's where I probably want to focus is go, okay, look, how do we get ourselves into a position where we don't have to say, I can't pay for that, I can't do this, particularly when somebody's got a tremendous amount of equity in their cattle, 50% or so.
Are you in the beef industry looking to stand out? Trust the experts at IMI Global and Where Food Comes From, the leaders in third-party verifications with over 30 years of experience. Their team knows agriculture inside and out, ensuring you get innovative and personalized service every step of the way. They help ranchers all over the country add value with programs like Age, Source, NHTC, Verified Natural, CARE certified, Angus verified, and Angus linked. Are you ready to add value? Get started today with IMI Global and where food comes from. Visit imiglobal.com for more information.
Yeah, I couldn't agree more. As a banker, what I really want to see is everybody keep their hedges in place, especially in a market like this. If we were at the bottom end of the market, I probably wouldn't be as big an advocate for you probably should keep your hedges in place. And that's always a borrower's decision. It's really not the bank's decision. It's the borrower's decision. The key is you got to have a lot of communication, whether you be the largest borrowers out there feeding cattle or the smallest. And your banker really needs to understand what you're up against when you are in a market like this where prices have risen, significantly. Everybody's in a little bit of a cash crunch. It's not easy to get that money on a day's notice. You need that money in your commodity account or you're going to blow people out of hedges. That's just the way it works. But what's important from a producer standpoint is we all have to be having the right communication, the right conversations so that money is readily available. And where this really becomes a problem is when there's no planning that's been done. So as the market was running, make sure you're talking to your banker frequently and you're giving yourself enough time to make sure you've got the money set up to make those calls because those kind of things don't happen overnight. I mean, if you're borrowing, $500,000 or $1 million or more, it's not like you're going to probably be able to get that money in a one-day turnaround. Have a lot of conversations with your banker, have a lot of conversations with your commodity broker. Probably those two people ought to be talking and make sure that you've got everything in place so that you do not miss out on a margin call and you can keep your strategies in place because it is the borrower strategy. It's not the bank strategy. And what I always want to make sure of is that whatever my customer wants to do, that's what we're able to do. And that only happens through great communication.
So I've heard guys say my banker makes me hedge, and I know that that's probably not true. Okay, so there's a difference between makes and incentivizes. So can you kind of go down that path a little bit and talk to us about, maybe what you guys do, what the incentive, why would a banker encourage or be behind someone that's managing risk?
So I think the right word is encourage. What a lender really wants to stay away from is lender liability. And if I'm requiring a person to hedge cattle, and then let's say they, put a hedge on, they sell their cattle at 200 and they run to 230, well, the borrower can come back and say, well, you just lost me $30. And that's never a position a lender wants to be in. Now, there may be lenders that put themselves in that position, but really encourage is the right word. What we like to do is we give incentives for being hedged. So you will not have to put as much of your own equity into a cattle feeding deal if you hedge your cattle. What the reason why is it's taking the bank, you're basically hedging the bank's portion of the money in the deal is really what you're doing because you're able to borrow a lot more money than you're probably putting in your own equity. So as a banker, we want to have those cattle hedged so we know our position is safe. I'm not looking for guys to hit home runs. I want them to hit singles. So I want them to hit a single every single day of the week. I'm not looking to finance a person that hits a home run once a year. I want a strategy that I know they will make money every day in every market. If you went across a whole year, there people may lose money here and there, week to week, day to day, but in general, month to month, in cattle feeding, if they have a sound strategy from start to finish, they're likely to make money every single year.
Yeah, and so I think part of that's probably just understanding your borrowing base more so. So let's say I'm a guy that I've been feeding cattle here for a couple of years, and I've started out, and I've got I haven't necessarily had to do a borrowing base. I just said I've got these cattle, and I went and borrowed some money to finish those cattle out. Let's say I've made pretty good money on this set of cattle, and now I'm doubling up, and I'm going to buy another set of cattle. What is a borrowing base? Like, what can you explain what that is? I know we have conversations. I've got conversations with my guys. Explain what that is and like what the point of that is.
In the very simplest term, a borrowing base is a report you're going to furnish to your lender, most likely monthly, maybe quarterly. And in its most simplest terms, if let's say I'm just financing the cattle, I'm not financing feed or anything else, you're going to have the cost of the cattle on the borrowing base versus the loan on the cattle. So it's going to show your equity position. And there's different ways to value the cattle. There's different ways. Every bank does this. But in general, at least the way we do it, what we're trying to strive toward is to value those cattle at market every single month. So we want to know, what are those cattle worth every month when they finish. I don't really care so much about what you paid for them. What I really care about is, what are they going to be worth the day you finish them, and what's it cost to take those animals to finish. Does that make sense?
Mm-hmm.
So that way, every single month, I know exactly where you are, and you know as a producer exactly where you are and what your equity position is. So it's a protection reporting mechanism for the bank, but it's a great management tool for the producer, because every single month, or what I would say hopefully is every single day, they know where they are on their equity position in their animals and their feed. So as it gets more complicated, you have feed on there as well. You have receivables. If you do prepaid, you have those on there. So what we're trying to do is lend the producers an adequate amount of money so that they can keep their strategy in place. You know, you would think today cattle prices have risen dramatically. There's cattle coming out of the feed yards making $100 to $300 per lot per head. Well, nobody's got any cash because all the money's going back into the higher priced cattle, right?
Mm-hmm.
And so that's just where we are in the industry. And that's why a borrowing base set up and a revolving line of credit is important, because a producer needs to know he's got the money to continue his strategy.
You keep saying strategy and communication. And I think communication is a key to a lot of things. It keeps everybody, if you can keep everybody on the same channel, on the same wavelength, it don't matter what you're doing. That communication is key. And a lot of people don't like to make those phone calls, but they need to be made. I mean,
that's right.
And I'll tell you that we were talking about this earlier, and it's like we like being in the calmness, the water, where you don't necessarily have a whole lot going on there. You like being in the lazy river, I guess, if you will, because you don't really have to do a whole lot there. Whenever things starts getting real choppy, and whether the market's going up or down or whatever it's doing, it gets real turbulent, and we don't know what to do. And so I think the biggest thing is like stepping back from a weekly standpoint and going through and trying to understand where you're at, where you're going, what you think the market's going to do, and then putting that in kind of a financial plan. But like I said, when we first started this, most guys don't have the ability to do that on a daily basis because they're so busy. They're
Sure.
exhausted, one, because they've been feeding cattle all day long, or they've been riding their horse, or they've been doing whatever. But as we've grown, and this market has been extremely fun, extremely exciting, and extremely rewarding. And the craziest thing is when we got to the market highs that we just recently experienced, people were freaking out mostly because of lending. I mean, it's like we're running into constraints, from that standpoint. So I think that to your point, just having that borrowing base, that ability to go back and go, okay, where am I at today? Oh, a hedge, yeah, that does lost me some money, but I've got the rewarding side of it from a cattle equity or a cattle market appreciation standpoint.
Right. And there is a cost to hedging for sure. And we get pushback, sometimes because of what I talked about earlier. Well, why would I want to sell my cattle and put a hedge on them today when I think this market may run up another $20, $30? Mm-hmm. What the hedge is really doing, as you well know, it's protecting the producer's equity position and the banks, of course. And what we don't want to have happen is we have a $30, $40 drop, and now all the equity's gone. Mm. So the more money that you're borrowing, because in general, whether you're borrowing $200,000 or whether you're borrowing $20 million, the equity is likely the same that you're going to have in those cattle. It doesn't necessarily change because you're borrowing less money or more money. It's probably the same. So think about how many more dollars are on the line as these operations grow or the cattle, double in value. There's just a lot more equity riding. And that's why we like to have hedges in place, because we just don't want to see a producer get blown out. There's not a lot of options. Especially like, think if you're a younger guy, growing your operation, you've done well, everything is going good because the cattle market's been good. You've done a great job buying cattle, great job selling the animals, great job managing the animals. You can't do anything about the market. And if you're getting a position where you don't have some protection, you could very well lose all your equity in a very short period of time. So that's the concern.
Well, so y'all explain this to me then. Yeah, we're concerned about the equity position, but also with this big run up, there's the margin calls coming. So what happens when that account's drained and this thing keeps running up? That's the communication you're talking about. That's the communication between your commodity broker and your banker that need to be happening. Look, if this thing keeps running up, we're going to need this much more money. You might want to go to figuring that out. Because shouldn't your equity grow too so you could loan them more money on the margin account, or am I looking at that wrong?
Yeah, Ty, what I would say on that is it's really two separate issues. So I almost separate the margin part of this.
Correct.
Because that money's got to go out no matter what, and it's probably got to go out in the market we're in, 100% financing from the bank. So I'm not, if you call me and say, well, I got to make a margin call, well, I'm not going to go out and try to find out, well, what cattle inventory do you have today? And we got to get that done. And so that money is going to probably be supplied by the bank at 100%. Now, on the equity side of this thing, typically, now every bank is different. Okay, so when I say typically, what I mean is whether I'm lending a guy $100,000 or $20 million. Let's say I finance 200 producers. Pretty much their loan requirements are likely to be almost the same in terms of how much equity they got to put in those animals. And a severe market drop, it's gonna harm that producer, and it's going to do it in a hurry. And so all I'm saying is,
yeah, but it's going to harm him on this side, on the equity side.
Correct.
Okay, so let's say these cattle are hedged. It's gonna. He's covered over here on this side in this account. You got two different accounts. You got your
I don't know if he's
account.
I don't know if he's explained that. So we might have him explain what he means by that, because I don't know if we really digest. Because I think most guys. I mean, I'm going to tell you, the vast majority of people that I work with at Blue Reef that are hedging cattle, and this is what we're really trying to explore, and I'm trying to learn more about. Honestly, again, we don't try to learn about things until incentive drives outcome. Yeah, it's like, I need to go to the doctor.
So we're sitting here naked.
Yeah, that's right. So, so what John had mentioned is having two separated accounts. So you have an account where you have the amount of equity that you need that's required to buy the cattle and how much money you're putting up, and then the 80% that the bank is going to loan you. John, explain the strategy or the plan or however you go about what you use for producers on hedge accounts, because like I said, most of them they're all dipping in one pot.
Well, whether it be a separate loan on bigger accounts, when I say bigger, I'm going to say loans in excess of, let's just say $5 million or greater. A lot of those we will do a separate hedge account, or at least a sub account where that money is only there for hedges. So as a producer, let's say I set $1 million in there. I think you ought to at least have 10%. If you're borrowing $1 million, I need to plan on at least $100,000, 10% of that loan set aside for margin. And I need to be comfortable lending you that money as we start the season. If we meet once a year and we set up a plan, then I think what a producer ought to be asking is, do I have 10% set up? And I think that's probably a minimum, at least in this market, the way it's run, for margin calls. And then as a producer, you can monitor that, whether it be in a separate account or it's all in one loan. You should know, well, if I've put out, to my commodity broker, 80,000 of the 100, now the market's still running. I'm running short.
We probably better have some conversations.
Exactly.
We're going to need another 50 or 100 or whatever.
That's right.
Well, typically when the market has what they refer to as a blow off top, it's typically the producer blowing out of hedges. You go from, and I talk about this with my customers at length all the time, where we talk about fear, hope, greed, panic, and all those different emotional cycles of things. It's like right now where the market has had lots of chop in it. It rallied up, and we put in a high there at the end of January where we were kind of 207 fats and, call it right bumping up against 280 feeder cattle. And then the market corrected and then rallied back. And we're going to see these big ensuing, and everybody acts like volatility is new. Volatility is not new. they've been saying volatility is new. I'm 44. I got in this industry at 24. It's been new for the last 20 years, right? So it's just part of doing business,
Right.
honestly, right? So what gets people messed up in my mind is what I refer to in a market is the zone of ruination, and that's when the market's in not in a trending aspect, it's in a choppy aspect, where a producer that never thought the market was going to go over $2 convinces himself that the market's going to go to $2.15 or $2.20 or $2.30 because he's feeling the pressure from whether his wife's saying, why am I sending this money out? He wakes up and he's got a margin call in his account. He calls his banker and says, man, I can't make this. And then he just says, get me out. And a lot of times that's whenever you have the blow off tops. And so I have experienced people that have come to work with me that have blown out at the top. And so my biggest fear, honestly, in this market as we go through this is having a producer that has, let's say I've got $1 million line of credit. I've got $200,000 of my own money in there. I've got $800,000 borrowed. The market goes up, and then all of a sudden we have this valuation there that's high, and you're like, man, I've never been able to make this amount of money again. And I sell the market, futures market, and then the market goes another 15% or 10% higher than that, and you don't have the capital or the borrowing capacity or the relationship to manage that. And then every day you go, man, I'm stupid for doing this. Why did I do this? And then boom, you get out. And what you thought was locking in a $200 profit, and then we see something happen, a gray swan, a black swan, something happen in the market, and then all of a sudden you lose $300 ahead. And then originally you had $200 put up. Now you can't be in business anymore, and you still owe the bank $100.
That's right. And that's exactly what we're trying to guard against, because and I keep using the word strategy, but what you just described is why the producer should think through the strategy with the banker, with the commodity broker, so that he's disciplined about, okay, I've already explained and I've thought through for my own self why I'm making these margin calls, even though it's costing me money, because the producer went into it with a strategy that's what he was going to do. Whether the market was over 2 or under 2, he went into it that year full well saying to himself, not to the bank, I want to hit singles. I'm not trying to hit a home run because I want to keep playing baseball. Yeah. I want to keep cattle feeding, and I want to do it for the next 20 years. And nobody has unlimited amounts of equity. So, and we don't know when the gray swan or the black swan or the purple swan or whatever color the swan is. We don't know when it's going to come next, right? And so that's why this defined strategy is so important to talk about and think through with your banker, with your family, because really it's you as a producer and your family that are making this decision. You're coming to the bank to get some money. As a producer, you've got to do whatever's right for you and your family.
Yeah, and that's one strategy does not fit all.
Right.
So, like you said it best right there, you got to do what works for you, what's best for you and your family and what you're doing. I mean, whether you're running light cattle, whether you're going to precondition them, have a background in the yard, whether you're going to feed cattle all the way through, there's strategies for every one of those. You just got to get to that strategy.
Exactly.
And you got to get the right people. We've harped on this a lot of times since we started this deal. This is a people business. This is a relationship business. So you got to find those relationships with the right people that you trust and that you can move forward and trust them to strategize for you, because you can't do it all. Just like Casey was saying earlier, we got these people trying to be the CEO, the vice president, the janitor, the feed bunk guy, the doctor. You can't be good at none of them if you're trying to do them all. And so we got to come up with the right strategy. You got to get the right people in place, and then you got to have your plan. So do we want to dive more into this market, or do we want to kind of the volatility of the market? Have y'all covered everything you want to talk about there, guys? And is there any more questions you have, Casey, about the different accounts, about, that helped me a lot. Was I have a revolving line of credit over here to buy cattle with. Okay, and I want to scale up my operation. But man, I've gotten nervous. My dad never did it. My granddad never did it. My great granddad never did it. They thought hedging, and my great granddad, every time he looked at that board, he'd say, "Somebody needs to go shoot them people." And so they never went naked all their life, and it worked for my dad, and it worked for my granddad. I mean, it worked for them. But at these levels, I mean, yeah, it's always cost a lot of money, but you could lose the ranch. You could lose your things you've been working for all your life at these levels,
right?
With one little stump of the toe. So now people are thinking, we might ought to get serious about doing some hedging and stuff. I've never even thought about it, never even done it. But at these levels and trying to grow the wheat cattle deal that we're trying to do and then trying to buy some cattle early on to kind of to keep that cost down, buy them lighter and keep them longer, to keep that dollars per head down. That makes a lot of sense having a hedging account too. Just one account, you have 10% sitting over here to hedge with. A lot of people don't know that that's an option. A lot of people didn't know that. I didn't. I've been doing this. He said we've been doing it since we was in our 20s. Been buying cattle since I was 15, and I didn't know you could set those two different. Maybe it's because I didn't want to know, but I didn't never know that.
And I think the most important thing, or one of the more important things, is like just that exposure part of it. And then the biggest thing is, and I always go back to this behavioral psychology and like what's in your mind when things are going on. So like, let's say it's this. Let's say you're 50% hedged. The market goes up $20 a hundred. You just picked up $10 a hundred. Okay. But what most people are going to do is they're going to go, I gave up $10 a hundred. Right. And then what you should be doing is selling the next 5% or 10%, legging into the next part of sales, because we know it's easy to step back and look at markets in hindsight and go, man, I should have done that. But when you're and then you got your back against the wall, and you got your broker calling you and saying, I need to margin this thing. And then the other part of this thing that happens is not only that, but you miss opportunities. Mm-hmm. So the market goes up, you miss an opportunity to sell more. Ty, you call somebody and offer them a set of cattle and they tell you no because they don't have the money to do it.
They've been doing that a lot the last couple of days. I don't know if you know that or not, but we've been hearing no a lot here lately. You figure on these high markets it'd be easy to sell one negative.
Looks like there's a lot of people buying them though. It's crazy. But again, I think, like I said, prices that we thought would be not attainable and we thought would be awesome to get to, we somehow convince ourselves mentally that those prices are cheap now. And so that's where I really try to drive home, and my customers are probably going to listen to this and know what I'm saying. It's something to where what I try to drive home is this is mental warfare. This is a thing of making sure that you don't, you sell cattle and the market goes up and you don't, bang your head against the wall and say, I'm an idiot for doing that. You should go, man, there's another opportunity here to sell more. And making sure that you know what your inventory is, you know what the value of that inventory is, you know what the current market price is, and then that gives you the next step, and that's the opportunity. And again, John, I think it's awesome that you got on here and you were able to talk about these things so that we could go through and really learn. And I know we really harped on this part of the banking side of it, but I think this part of the banking side of it really folds into a lot of other things when it comes to that. So, but it's really kind of setting a plan and managing through that plan and trying to understand it.
And I think we'll get into that plan, so-called. We talked about strategy. Now we need to talk about plan. But I think we probably need to do that on the next one. So
you guys are going to invite me back.
We're going to have a part 2.
Man.
Yeah. So whether you like it or not, you're going to be on part 2, and we'll continue this education on. Okay, now we've talked about the different stuff through the hedging and all that stuff, and how the financing part works. Now let's just dissect the plan on, okay, how do we set these strategies up? Who do we get involved in, and who do we go to? But first, we're going to have to do that later. So we need to take a little break here. We appreciate everybody for watching and tuning in. Thank John for coming on and trusting us to share all this with us. Remember, if you're watching on whatever platform platform you're watching on, hit subscribe. As Katie says, she said, be sure to tell them to hit subscribe. So we're going to hit subscribe and hit like, and join us next week for the follow-up with John, and we will get into that strategy and that plan on what that looks like on the ranch or on the farm or on the grow yard or whatever your program is, whatever your program for however you want to run your cattle. So thank you for watching. Remember, we live it. Thank you, Casey, for being on, and we'll see you next time.